Hello, and welcome to Advanced Projections May 2020 update. Welcome back, and we hope you will find our information to be both insightful and valuable in terms of dealing with the current environment. We're all now very aware of the pervasive existence of COVID-19 and its potential to wreak havoc on a large scale across the globe. As of this writing on May 8th, 2020, the number of cases in the USA has gone from less than 210,000 cases to over 1.2 million in a matter of 5 weeks, a six-fold increase in a little over 1 month, keeping the USA in the very dubious position of continuing to be the #1 global hotspot for identified COVID cases. Global cases at the time of our last report were about 1 million and are now rapidly approaching 3.9 million and with a certainty to have gone through 4 million by the time many of you read this report. It is our considered opinion that global cases will reach several millions more, that U.S. cases will reach 2 million or even higher, up to 3 million perhaps, all with a commensurate fatality rate significantly higher than our previous view of 2 to 2.5%, being much closer to 6%. This is truly horrible, especially in light of the earlier attempts to trivialize the situation during January and February. We continue to urge people to stay home, diligently practice social distancing and strict disinfection practices, and to be rational in your approaches necessary to protect your families and loved ones. While the worst hotspot, New York City, appears to be calming down somewhat, fresh exponential increases are showing up in America's heartland, right at the time where many states are trying to get people back out from under mandated stay-at-home directives. This is a sure recipe for a rebound wave of infections and rapidly increasing case and fatality rates. During March, the psychologically fragile equities markets rolled over rapidly, faster than any time in the last 100 years. In a matter of a few short weeks, the S&P declined by nearly 1,200 points from its February 19th peak of 3393. A couple of intermediate anemic recoveries still did not prevent the markets from registering their worst one-month decline since the Great Recession. Due to that continuing decline, in April, our APSI stock indicator index went red for the month, as we clearly stated would happen in our March report. After bottoming out below 2,300 in March, the S&P has more gradually recovered about 60% of its losses by the end of April. However, we are certain it will eventually retest that 2,300 low and probably drop through it as more and more investors become concerned about the as-yet unannounced recession which we have already entered. During this extended downside period of the business cycle and investment cycle curve, be aware of several bull traps along the way, as shown in an illustration which we provide in our written report. This illustration shows both the first and second bull traps on the way down for the S&P 500. As we enter May, we believe that the second equity bull trap is being completed, and we look for another swoop down for equities during May or June. This is happening more slowly than we anticipated in our April report. Typical major bear markets have 4 to 6 of these bull traps along the way towards capitulation sell-offs near the market bottoms. At the end of February, the yield curve had remained inverted, and our APYC indicator showed yellow for that report. On March 3rd, the Fed did respond to the COVID crisis with an initial 0.5% rate cut, understanding that the economy stood to suffer significantly from both real and perceived threats from a potential pandemic. as well as trying to calm the growing selling pressures in the equities markets. This first rate cut undid the rate curve inversion that had begun, and the entire rate curve dropped dramatically. Later in March, the Fed dropped short-term rates back to near zero. In the short term, the yield curve flattened downward directly due to the Fed rate cuts, and in the intermediate and long terms, due to the flight to quality as the equity and oil markets began their downward spirals. The two Fed rate drops in March uninverted the curve, but that may only be temporary, as money is likely to move once again from damaged equities back to the relative safety of bonds and completely flattening the yield curve. Due to this collapsed yield curve, our APYC indicator remains yellow for May. The collapse of oil continues. In December 2019, WTI, otherwise known as West Texas Intermediate Crude, was trading a bit north of $60 per barrel. By late February, prices had declined about 25% to the mid-40s, and during March, there were significant price declines down to $21 a barrel. In April, the full effects of the oil glut hit hard, making the short-term price of oil actually go negative for a few days in the middle of April. The negative price was a consequence of negative demand for oil for a brief period, given that there literally was no place, storage, available to put it. Since then, production has declined somewhat, the storage situation has improved, and oil is now hovering back in the $21 range. We believe that declining demand will continue and prices will fall back into the teens, where they were for a few days in April, per our March prediction. Depressed oil prices are great for the consumers who use the product, but very bad for the industry which supplies them, as they cut back on drilling, refining, and new purchases or upgrades to the equipment used therein, not to mention the workers who will also be laid off. The net result is actually another rather large hit to the economy, which is just now in its incipient stages and will be part of the economic contraction we have recently entered. The first bankruptcy filings in the oil sector have already been announced during April, as well as massive layoffs to industry workers. Gold spent much of the time above $1,700 an ounce in April, establishing anew its highest levels in almost 7 years. We have already recommended that it is time to cease holding either rhodium or palladium any longer. In our view, there is very limited upside potential, and the industrial demand for these metals used in automobiles and oil refineries is now suffering significant declines, so their prices should continue to fall back sharply. Month-end pricing for gold and rhodium still puts our AP precious metal indicator in the red for the time being. As rhodium prices will eventually move down relative to gold over the coming months, that indicator should go yellow, then green. During March, the Fed had fired its last big guns during the government attempts to forestall and soften the economic blow that COVID-19 is delivering to the economy. It has taken its downward course on interest rates all the way back to near zero rate policy and has committed to a series of steps designed to pump money into the money supply and the rest of the economic system. Our early warning AP money supply indicator, which upon reanalysis we recently performed, had provided a warning far back in 2018, but now stays solidly green as the Fed continues to pump money into the money supply at record levels, supporting the federal government's financial stimulus package and outlays that will be totaling well over $2 trillion. The Federal Reserve's weekly aggregate measure of economic stability now puts us into a red recession warning for our APFD or Fed indicator. This will be for the second month in a row. Over the past 6 recessions, this indicator has been highly reliable in its ability to confirm that a recession is on the way. Here is what it did in an illustration again in our written report, that the indicator showed advance warnings in the last 2 recessions. and is now showing this in anticipation of this recession. Finally, we have this month's most significant AP indicator development. In past recessions, leading economic indicators have tended to fall off a cliff, moving from green to deeply red in a matter of just a few months. Leading economic indicator reports, as reflected in our AP-LI statistic, are coming out late from the Federal Reserve as usual. But, as we have been claiming for a couple of months, a precipitous decline in LEIs has begun. Our first out group of LEIs comes from a well-known organization called the Conference Board. And here's what they said about their set of LEIs for March. This text courtesy directly from the Conference Board. Released Friday, April 17, 2020. The Conference Board leading economic index for the U.S. plummets in March. Largest decline in index's 60-year history. The Conference Board leading economic index for the U.S. declined 6.7% in March to 104.2, following a 0.2% decrease in February and a 0.4% increase in January. In March, the U.S. LEI registered the largest decline in its 60-year history, said Alaman Ojeldrem, Senior Director of Economic Research at the Conference Board. The unprecedented and sudden deterioration was broad-based, with the largest negative contributions coming from initial claims for unemployment insurance and stock prices. The sharp drop in the LEI reflects the sudden halting in business activity as a result of the global pandemic and suggests the U.S. economy will be facing a very deep contraction. That's how they saw the drop in LEIs. We expect their April LEI numbers, due out in mid-May, will continue to show significant erosion, and that the Fed's own LEI set for March will now exhibit similar precipitous declines. While equity prices, part of both LEI sets, have moderated in their declines temporarily, the other significant contributor, unemployment, has literally exploded. Job losses in April, announced today, May 8th, have erased all of the hard-won job gains made from 2009 through 2019, and even more, with over 20 million jobs lost during the April 1st through 30th time period. In the weeks since then, yet another 3.2 million jobs have been lost. Weekly job losses in the millions will continue for a while yet before leveling off. May could very well see another 8 to 10 million job losses, in spite of attempts by states to reopen their economies somewhat. Additionally, a COVID infection rebound is a significant possibility and would continue to damage the employment picture. So, for this May report, our final indicator has gone solidly red, and we can unequivocally say that a recession began in March, and there is a high 90+% probability that the Fed will declare a recession in mid to late summer of 2020. So in conclusion, only one of our 6 indicators has returned to green territory. We are raising our probability of a near-term recession occurring to nearly 100%. We calculate that the actual onset of a recession has already begun around 8 weeks ago and will become officially declared within a 4 to 5 month window. Further modifications to this scenario will depend on what happens in the days and weeks ahead, but events are highly unlikely to change the outcome of what has already been set in motion. Our monitoring of Federal Reserve data shows that they have shown a GDP contraction already taking place in the first quarter of 2020. The emotional response of savvy and professional investors to economic activity that will be clearly continue to decline, as well as developments in the political climate, will likely take the driver's seat, and any raw impetus provided by Fed rate cuts and the recently implemented federal stimulus program over the next 6 months of 2020 will not be effective enough to reverse the existing course of entry into a recession. Here's our final notes. In the final notes for our March report, we stated that our gut intuition had told us that the recession probability for March should have been higher, 90% or more, based on the most immediate facts and events available at that time, but we needed the data to validate this intuitive call. Since we base our actual numbers and indicators on available data, we now have gotten the required confirmation via the Fed and Conference Board data, published within the last couple of weeks, and we have now reached this final stage in declaring an imminent recession. As of this writing, losses from the S&P 500's peak of 3393 were only about 13%, but we think that they are going to be much more severe than that, reaching 55 to 65% down into the 1200 to 1500 range. Whenever the bottom is going to finally be put in, probably in the depths of the recession later this year or into 2021. If you are not risk tolerant over the long term or cannot wait the usual 5 to 6 years of recovery time that equity indexes typically take to get back to break even, you should not have any raw exposure in the equities markets at this time. It would be best to be on the sidelines and wait for the worst to come and go, waiting to get an all-clear signal from our indicators as to a much safer re-entry point. Remember, the principles of capital preservation and risk management that must underpin every serious investment strategy. Risk takers who lose 50% must follow up with 100% gains to simply break even. If they lose 65%, they must follow up with 200% gains simply to break even. So please be realistic in your outlook and planning. You will not miss out on anything truly big by being a rational and conservative investor at this time. Thanks for listening. We'd love to hear back from you. So please look at our Facebook page, post there, or send us an email at subscriptions at advancedprojections.com. You'd be very welcome to do so, and you can address them directly to me, Rich Vessel, the founder of Advanced Projections. Thanks again, and we'll talk to you in early June.